We have now learned how to enter transactions into the ledger. But how do I know if a transaction is an asset or an interest? Let's have a look at some of the different classifications. Assets are defined as a resource which is controlled by the enterprise and from which future economic benefit is expected to flow. There are two different types of assets: non-current assets and current assets. Current assets are assets which are expected to not be converted into cash in the next financial year. This includes property, plant and equipment and things like investments. Current assets would include things like debtors, inventory sold, petty cash, bank, prepaid expenses and accrued income, which is income that is earned but has not yet been received in cash. We have learned that interests include the equity and the liabilities of the enterprise. And interests are defined as the owner's and the creditor's financial stake in the business. Equity includes the owner's financial interest and includes things like his capital investment, the net profit or loss of the business, and drawings. Liabilities are made up of two categories, namely fixed liabilities and current liabilities. Fixed liabilities are defined as a liability which is payable over more than 1 year, and this includes things like mortgage loans, bank loans, and vehicle finance. And current liabilities are payable within 1 year and includes things like trade creditors, bank overdrafts, accrued expenses, which are expenses owed but not yet paid, and prepaid income. The act of finding the balance in a ledger account is called ledger balancing. And this is obtained by setting off the sum of the debits against the sum of all the credits, and therefore the balance of a ledger account is the difference between these two sums. There are a few rules to remember when balancing ledger accounts. Firstly, where only one entry is made, leave the account as is. This is the balance. For example, let's say the only entry affecting our bank account during the month was an expense for 300 Rand. This would then be the total, and we would close off the account at 300 Rand. Secondly, where more than one amount appears on one side only, add the totals. This then becomes the balance. For example, let's say the only transactions affecting our bank account for the month were services rendered to the value of 1,000 Rand, and one of our debtors partly settled one of his accounts for 500 Rand. We would then add these totals, and we would close off the bank account with a total of 1,500 Rand for that month. And then thirdly, where the same amount appears on both sides, this account has no balance. Draw double lines. For example, let's say our bank account had an inflow of cash for services rendered to the value of 500 Rand, and we had expenses to the value of 500 Rand in that month. These two values would then cancel each other out, and the bank ledger account would then be closed off at a zero amount.